What if you could make money in the stock market every single week, even if the stocks that you are holding didn't make a move? That's what we're going to be covering today in Mastering Cover Calls. This is one of my favorite strategies to generate passive income as well as risk management, right? It allows you to hedge and do some things. And we're going to go ahead and jump right in. So, my name is Kevin Tennerson. I'm one of the Flex Financial Wealth Coaches here at Flex Financial Trading Group. I'm sure as you go through the videos, you'll see Courtney as well, my business partner. And we really just love teaching people what we've learned in the stock market and giving them some tips and things that we've kind of come across and polished over the years and kind of put together our own program. So as we go through, I'm sure you'll see that, we really love talking about this. We're going to give you some tips, some tricks, some things that can help you with, growing your portfolio, and really just some great trades and great strategies that fit together in a system that are going to help you grow your portfolio. So what we're going to learn today, again, we're going to be going over cover calls. So we're going to cover what exactly is a cover call, right? Going over the definition, how you can use them within your portfolio, how you can trade them. Also, we're going to go over key terms, things you need to know, some words that you may never have heard of before, but we'll go through those definitions as well. And then lastly, we'll go through some real world examples. We'll go through a stock that I like to trade cover calls on right now, kind of go over how we're going to help you with generating 3 to 5% using this trade every single month. And that's what we're going to cover today. So let's go ahead and dive in, like I said. So how the stock market moves, this is something you need to know if you're new to the stock market. It's really not that hard, right? The stock market can go up, it can go down, it can go sideways, and that's it. Really what it is our job to understand what direction the market is going in and what trades we want to utilize based on that movement. We like to think of our trades as entry points into the market, right? When the market has strong upward movement, we're going to use different entry points, different trades. When the market kind of gets stagnant and kind of starts to, level off, we're going to use some different trades to kind of take advantage of that, and again, different entry points. And then when the market is going down, we're going to utilize some different trades. The nice thing about cover calls is you can utilize this trade no matter what conditions are going on in the market, right? The market's going up really strongly, we can utilize cover calls. If the market slows down or starts to actually dip, we can still use cover calls to generate some income during those times. So we're going to be talking about how to do that, and we'll keep moving forward. So what is a cover call, right? So a cover call, if you want to put it simply, is when you actually own shares of a stock and you are willing to allow someone to take those shares from you at a certain date at a certain price, right? So let's say I buy shares of just a made up stock, XYZ stock, at $99, and I want to give someone the ability to buy those shares from me at $100 next week. And next week would be June 6th. So I can go ahead and sell a contract to allow someone to buy those shares from me on June 6th if those shares are higher than $100. So that's what a cover call is. I own the shares, so I can cover the call. I'm selling a call option to someone else out there that's going to have the ability to take those shares at a certain price at a certain date if it does cross that price. And doing that is selling a cover call. And the reason we do that is because the person on the other end that is guaranteeing that they can lock in that price, they're going to pay me a cash premium, right? So that cash premium is cash that I get immediately into my account that I can use to do whatever I like, right? I can take that out, I can spend it. But if you are utilizing the full system, we're going to be using that cash we're bringing in from these cover call premiums, and we're going to be using that to reinvest into our account, buying long-term holds, additional shares for trading, things like that. So one of the things I've talked about here is you must own 100 shares of a stock in order to do a cover call, because all call option contracts do represent 100 shares of a stock. So if you do not own 100 shares of a stock, you cannot sell a cover call. You can do some other things with selling calls, but it wouldn't be a cover call because you do need to own those 100 shares to cover the call. And then you earn premium regardless of the stock movement. So that's one of the reasons why we really love this trade. Let's say I buy again 100 shares of XYZ stock. I sell the cover call. That stock doesn't go anywhere, doesn't move. I still get to keep the premium. And if it doesn't cross the strike price that I've set for to deliver at, then I get to keep the shares as well. So it's a really great trade. If it does cross strike price that I've chosen, and I do deliver the shares. Not only am I getting the premium, but I'm also getting capital gain. So this is a great trade. Again, you're taking in the premium no matter what happens. The stock goes up, the stock goes down, you're keeping the premium. And then depending on if you deliver the shares or not, we can go ahead and redo the trade if we keep the shares, or we can buy another round of shares if we want, if we think the stock is going to continue to grow, or we can move into another stock, buy 100 shares there and continue to do this trade. So that is what a covered call a covered call is. Again, we're buying 100 shares or owning 100 shares of a stock, and we're selling an options contract that allows someone to take those shares from us at a certain date at a certain price that we determine. And again, we're going to get a cash premium for that. So moving right along, key terms to know, some things I've kind of already jumped into. You may have heard me say, but I'll go ahead and give you all the definitions. So one, call option. We've talked about this again. It is a contract that allows someone to take shares at a certain price at a certain date. Call options, people buy call options when they think a stock is going to increase, right? Because a call option is going to increase in value as the stock increases in value. Now, there are puts that increase as the stock declines in value, but for today, we're just talking about calls. So a call option is going to be a contract that the buyer is hoping that the stock will increase, and the seller is selling to them to take in a premium. Now, the premium is going to be that cash, right? So as we go into the option chain, and we'll jump into this a little bit later, the premium is going to be in the bid column. So you're going to know exactly how much you're going to make in terms of premium by looking at that bid column. And when you're looking at the bid column, it is in dollars and cents. And we do want to multiply that by 100 again, because every call option contract is a multiple of 100 shares. So let's say, for example, I sell a call option and in the bid column is $2, then I would bring in $200 because I'm selling 100 shares for that. So that is the premium. Strike price is going to be the price that we decide we want to sell the shares at. So again, in the example I used XYZ stock, I bought it at $99. Now I want to sell it at $100. $100 would be the strike price. So at the expiration of the contract, if the shares are worth more than $100, I'm going to deliver them at the strike price of $100. And again, the buyer of the call option has locked in that price at $100, and that is why they're paying that premium. So even if the stock shoots up to $110, $120, they have locked in that price at $100 by spending the premium and paying that premium to lock in that price. The next thing we want to talk about is expiration date. So again, in the example, next week, June 6th is the expiration date that I would choose. So that is when that contract will expire. If the shares do not reach $100, as I've used in our example, and it stays below that, then that contract will expire worthless. They will not be able to execute and take the shares. So in that case, you would keep the premium and you would keep the shares. If it does go beyond that $100, you would keep the premium and deliver the shares at $100, taking into capital gains as well. And then lastly, I want to talk about in the money and out of the money. So in our example, again, I bought the shares at $99. So if I was to sell a call option contract for less than $99, say 98 or 97, that would be considered selling an in the money call option. Now, for the most point, we're going to be selling out of the money because we do want to take advantage of the capital gain side as well. And we do mainly only trade call options or sell cover calls on stocks that we are bullish on a long term, right? Because since we're holding 100 shares, we want that stock to increase over time, and we want to be able to get called out. So we're taking in capital gains as well as a premium. And then out of the money, which would be the opposite of in the money. If I buy the shares at 99, I'm selling a contract with a strike price higher than 99, say 100, 101, 110. All of those would be considered out of the money. So again, in the money, you're selling an option strike price less than your purchase price. Out of the money would be selling an options call with a strike price higher than where you purchased at. All right, moving right along. So why do we do cover calls? Why do we do this trade? So cover calls, again, is a great way to bring in and generate income in the stock market. Again, I really love it because no matter what happens to the stock, right? Maybe I'm wrong. Maybe the stock doesn't go up in value immediately after I purchase it. I'm still able to hedge that by selling cover calls, taking in the premiums until it reverses and starts to go up and get back to where I thought it was going to go. Or if it does go up immediately, I'm taking in those capital gains, I'm taking in the premiums. So really, no matter what the market is doing, we're able to utilize a strategy to generate gains within the market and have cash on hand, right? Cash is powerful in the market. It allows you to be able to be maneuverable, right? You want to take advantage of certain opportunities. Cover call writing and generating those premiums is going to give you the ability to do that. Now, we also like these because they're safer than naked calls, right? There are some things I talked about earlier where you can sell options in the market without holding the shares. Those are a little bit more risky. When you do own the shares, not only do you have the ability to, cover the call. So if you do get called out, you have the shares on hand already. You don't have to go out and purchase them. But two, if the stock starts doing something that's a little bit, different from what you expected, you also have the ability to do some other things that we can show you in the program by owning the shares. And lastly, you deliver the shares if the contract is exercised. So again, in that capital gain side, by owning the shares, if I buy shares at $99 and I'm selling call options with strike prices higher than that, if those shares do cross that strike price, not only am I taking in the premium, but I'm also taking in the capital gains on the growth of the stock while I own them. So those are all great things of why we love cover calls. But the biggest is it's a great way to generate capital in your account, have cash on hand so that you can make moves, buy shares of long-term holds, or get into other trades when you see those opportunities. All right, so now I want to take a quick look at a real world example. And today we're going to be looking at Walmart. So Walmart is a part of the Dow Jones, and we really like trading stocks in the Dow or the S&P 500 because those are proven companies, right? There are thousands of stocks out there, and there are going to be a lot of companies that are growth companies or have been on a great run, and they're outside of the Dow and the S&P 500. If you do your research, you want to trade those, you're more than welcome to. But especially for beginners, we like to direct them to the Dow and the S&P 500 because those are proven companies, right? The S&P is the top 500, the Dow is the top 30 of those 500, and you're going to be able to find some great stocks. Won't take you a long time. You can go through and kind of see some of the components of those and pick out some that are doing well that you can trade. So couple of things that we want to look for in stocks that we want to do cover calls on. And one, again, is we want to see stocks that we are bullish on in the long term. So quick way to do that, and we do cover a full strategy on how to research companies and how to look at them in the stock market. I'm going to give you a quick overview, just some things we want to look at as we jump in. So the first thing I want to look at is the financials. So we're going to go ahead and jump in. Now, if you haven't seen this before, this is Yahoo Finance, a great place to look at companies. It's totally free. You just go to finance.yahoo.com. You can look up any company that's publicly traded. It'll have all this information here for you. So the first thing I want to look at is the top line revenue, right? So every quarter, companies put out their earnings. They're going to let you know exactly what they're doing in terms of top line, bottom line revenue, and they're going to give you some guidance. We want to take a look at that top line revenue, and we want to see consistent growth year over year because that is going to drive that stock price higher. So if we look at Walmart, and these are in the thousands, so we'll see 572 billion in 2022. We see a jump to 611 billion in 2023. We see another jump to 648 billion in 2024, and then we see another jump to 680 billion in 2025. So looking at that, we are seeing that consistent top line revenue growth. I'm not going to get into everything else here. I just want to do a quick overview, but that is exactly what we want to see, right? We want to see those companies that we're trading, especially that we're bullish on, that are continuing to add to that top line revenue year over year, because that is going to drive that stock price higher as well. And again, those are the type of stocks we want to trade when we're doing cover calls, right? Because not only do I want to take in those premiums, but I want to start getting called out. I want to take in some of those capital gains as well and really grow my account. Now, the second thing I want to look at is we want to take a quick look at the charts. Now, again, we do break this down a little bit deeper. We're just going to go through really quickly here. And I want to take a look at kind of three different time periods. The first one is going to be short term, and I'm going to look at the 3-month chart here. And I do want to see some growth, and it is minimal, right? We did see a pullback here. We've recently had some talks of tariffs and some other things going on with inflation and how tariffs would impact inflation. So we saw a little uncertainty around the market. We did see a pullback. kind of market wide. But you've seen that Walmart was able to retrace and actually get beyond. So it did have some growth in this 3 month period. And that's all I want to see. I want to see it moving upwards over the short term. Then we want to take a look at the midterm, where we're going to be looking at the 6 month and 1 year charts. We want to see the same thing. So we want to see it higher than where it started. We can see it was back, it was 92.49. We did see that little bit of a dip, but now we see it's up to 98, closing in on $100 here in the 6 month. 1 year, we're seeing that it definitely has had some growth. It's gone from $64.89 up again to where it's at 98.72 today. So again, we're seeing that upward movement. And then lastly, we want to see upward movement in the long term, right? That 5 year chart. And on the 5 year chart, we want to see at least doubling your money, right? If I was holding these shares for 5 years, would have at least doubled my money. We're taking a look at Walmart 5 years ago. It was trading at $40. Right around $40, $41. And now again, it's up to 98. So we've definitely more than doubled our money. So that's what we want to see in the charts. Short term, midterm, long term, we're seeing upward movement in those charts. And that, along with the financials going in the upward direction, that's going to let us know that this stock is, showing us what we want to see. It's moving forward. It's moving up. It's a stock that we can go ahead and start trading some cover calls. And then the last thing I want to take a look at is the option chain, right? And this is where we're going to get to see those premiums that we're taking in. Again, this is the bid column, and this is a column we're going to be looking at for premiums. And again, we want to multiply this number by 100, right? So now we see today is May 30th, and this is a May 30th option chain. So since today is May 30th, these expired today, you can see these are worthless. So as you're learning options, and that's another thing that we teach, we go through and we talk about all the different Greeks, the things that impact your options, and time decay is one, right? The closer an option contract gets to expiration, the less value it has. Now we see expiration is at 0, so this one is expired, and that's what I talked about when I was saying that contracts expire worthless. Now, if I owned that, or I sold that call on that strike price of $99, and it got to today, and the stock did not cross $99. We see it closed at 98.72. It's still below that price. That means this contract expired worthless, right? So I got the premium when I sold it. Now that the expiration date has come and passed, it didn't reach it, I would keep these shares at this point, because the share price did not get past $99, so I do not have to deliver it based on the contract that I sold. So I would keep the premium and the shares. Now, what we want to do is we want to try to take a forward look at this, right? Because we want to be able to generate about 3 to 5% of what we're investing in order to make this a good trade, right? I want to generate 3 to 5% every single month on Walmart if I'm going to be doing cover calls on Walmart. So what I like to do is take a look at the 1 week call. So a week from now will be June 6th. And this is our bid column. So if I was to sell this call option for June 6th as the expiration date, and the strike of $92, which actually, let me reset this because it should be out of the money, should be $99, not $92. There we go. So got that updated here. So it's $99. And if you're looking at the option chain, this blue color, this light blue color on the option chain is in the money. So again, less than the actual stock price, right? So it's at 98.72. So anything less than that, 98, 97, 96 is going to be in the money. And then out of the money is going to be anything higher. So we have 99, 100, 101, and going that way would be out of the money. And it gives you a little blue tint here to kind of differentiate in the money and out of the money, right? So let's say I bought the shares today at the current price of 98.72, right? So in order to buy 100 shares, I would need to multiply this by 100. So we got 98.72 times 100. That's going to give us our purchase price, right? So I'd be spending $9,872 to buy 100 shares, right? So what I want to do is I want to generate at least 3 to 5% of this every single month, right? So I'm putting in the investment. I want to generate that income on my investment. So if I was to sell this call at this 99 strike price, I'd be taking in 94 cents or $94 per week, right? So let's go ahead and say we did $94 and we did this 4 times. So I'll multiply it by 4, and that'll give me 376 for the month, right? So I sold this call 4 times, brought in $376. Now I want to divide that by our purchase price, which was 98.72. and that's going to give us 3.8%. So almost 4% if we're doing this weekly, right? So we sell the call, we don't get called out, keep the shares, sell another call, don't get called out, keep the shares. If we're doing it that way, we don't get called out, it never crosses a strike price, we're going to generate that 3 to 5%. We're at close to 4% here. If we do get called out, which is even the fun part, let's say I buy them at 98.72, I sell the 99, I'm getting that 28 cents on top of that. So another $28 on top of the 94, and we continue to do that. We buy shares, sell out, then we're going to actually increase on this 3 to 5%, right? So that's a quick look at what we want to do, how we want to sell these calls, what we want to generate. So again, Walmart, a quality company. If you're looking for something to go ahead and start trading, it's doing a great job right now. But if that is not the stock you want to trade, I recommend you looking at the Dow, looking at the S&P 500, finding quality companies that fit the criteria that we looked at, right? We want to see the top line revenue growth year over year. We also want to see the charts growth, upward movement in the short term, midterm, and long term. And then we want to go through the option chain, and we want to be able to calculate out and see that we're going to be able to generate that 3 to 5% on our investment every single month by trading this stock. So that was Walmart. And now what I want to do is do a quick recap. So again, why we love cover calls is it's a great way to generate some passive income. I showed you just by trading one stock here, Walmart, and just doing 100 shares and doing one contract, what you're able to generate. Now, as you grow your account and as you get more comfortable with cover calls, you can do multiples of 100, right? If I have 1,000 shares, I can do 10 contracts. If I have 2,000 shares, I can do 20 contracts. Also, you can trade multiple stocks at the same time. So it's a great way to generate passive income and bring in that guaranteed 3 to 5%, right? We do a quick little calculation, taking a look at a quality company, and we're able to generate that. Also, the capital gains possibility, right? If the stock is growing, as we've done the research and we are finding quality companies that are moving forward, we're not only going to be able to take in the premiums, but we're also going to be able to take in the capital gains, which is going to just add to that 3 to 5%, help us grow our account even faster. And the greatest thing I think about cover calls is it works in any market conditions, right? If the market is going up, you're still keeping the premium. If the market is going down, you're still keeping the premium. So make sure that you do the first part and research the companies that you're thinking about investing in. That's going to help you with making great decisions, getting into great stocks. And then no matter what happens after that, you're going to be able to continue to write cover calls and generate those premiums. So that's what we want to cover today. Now, quickly coming up in the next video on cover calls, we're going to go into risk management and strategy design, right? So we're going to go a little bit further into how you can mitigate your risk, how we can help you with setting up your trades to be even more successful. We're also going to learn how to protect your investments and boost the consistency again. So we're going to take a deeper dive into that. So I will see you on the next session, and thanks for tuning in. Have a good one.